This is an Uncovered Japan Company research report on Nichicon Corporation, ticker 6996. Nichicon is a 75-year-old Kyoto maker of capacitors that also sells finished energy systems, including home batteries, vehicle-to-home equipment, and EV chargers. That unusual combination gives the company a distinctive place in electrification. But it also creates a tension between a cyclical component core, a low-margin systems business, and a valuation that already assumes a great deal of success. The first snapshot is deliberately mixed. Nichicon has a fortress-like balance sheet with a 61.2% equity ratio, but returns on that capital have faded, with fiscal 2026 ROE at 5.5%. Most importantly, the forward PE is 42.1 times, compared with a 13.6 times 5-year average. This is not a simple, cheap quality story. Investors are paying today for a recovery in earnings and for the possibility that Nichicon's energy and data center opportunities become more profitable. Nichicon's product story has two halves. About 58% of sales comes from aluminum electrolytic and film capacitors, used in areas such as automotive electronics, industrial equipment, appliances, and increasingly AI server power systems. The other 42% comes from NECST, its energy control business, which sells residential storage batteries, vehicle-to-home systems, tribrid solar and storage equipment, EV chargers, and industrial storage systems. Very few component makers have moved this far into complete systems. That vertical span is the strategic idea behind the company. The segment split explains both the appeal and the risk. Capacitors remain the economic core, producing a roughly 5.9% operating margin. NECST is already a large share of sales, but its reported operating margin is only about 1.1%. In other words, the finished systems business gives Nichicon a differentiated franchise, yet it has not proven that it can earn returns commensurate with that strategic importance. The key self-help opportunity is to improve NECST's mix and economics, potentially through service, maintenance, and more efficient system sales. Nichicon's recent numbers show the cyclicality clearly. Revenue peaked at 184.7 billion yen in fiscal 2023 during the EV boom, then fell for 3 consecutive years to 169.7 billion yen in fiscal 2026. Operating profit fell from 12.6 billion yen at the peak to 5.2 billion before recovering to 6.4 billion yen. The recovery matters, but it is coming from a depressed base. It also reinforces why operating profit, rather than a single reported net income number, is the cleaner gauge of how the underlying business is actually performing. Nichicon is financially robust. Its equity ratio has risen to 61.2%, and the report describes the company as near net cash. That balance sheet strength can help it endure a weak cycle and fund investment in electrification. But it is also part of the return challenge. ROE rose to 12.5% in fiscal 2023, then declined to 5.5% by fiscal 2026. For shareholders, the question is not only whether the company is safe, it is whether management can turn a well-funded balance sheet into sustainably stronger operating returns. Nichicon's defensible advantages are most visible in capacitors. High voltage, low ESR, high capacitance, and long-life parts require accumulated process knowledge and multi-year customer qualification. That makes switching difficult in reliability-critical uses. The company also has a real first-mover franchise in vehicle-to-home systems, having launched the world's first V2H system in 2012. And it led the domestic home battery market from 2022 through 2024, according to the report. The qualification is important. The capacitor moat is mature, while NECST's leadership has yet to translate into equally strong margins. Cash flow adds useful context. Operating cash flow rose sharply in fiscal 2024 and 2025, reaching 18.3 billion yen in fiscal 2025, before normalizing to 8.2 billion yen in fiscal 2026. The report cautions that those stronger years reflected inventory destocking as well as operating performance. Free cash flow improved, but the underlying cycle still matters. This is another reason to follow the direction of operating profit, inventory, and working capital together, rather than treating a single year of cash generation as proof that the business has become structurally more profitable. The strategic upside rests on two unproven levers. First, AI servers and data centers need efficient, reliable power management components, which could support demand for Nichicon's higher-value capacitors. Second, GX decarbonization, home electrification, and energy resilience support the longer-term case for storage, V2H, and industrial energy systems. The company has also launched industrial storage products, But the prior Vision 2025 plan missed its 200 billion yen revenue and 10% margin ambitions by a wide margin. The next midterm plan therefore matters as a practical test of management credibility. Valuation is the heart of this research case. Nichicon's forward PE of 42.1 times is roughly triple its own 5-year average of 13.6 times. The report also places it well above several capacitor and electronics peers. A high multiple is not automatically wrong if earnings compound quickly and returns improve. But it narrows the margin for error. Investors need to see evidence that AI-related demand becomes material, that the capacitor cycle improves, and that NECST can lift its low profitability. Without that evidence, the shares remain exposed to a multiple reset. The report's own 3-year scenario work is intentionally wide. Against a reference price of 4,205 yen, its base case is 2,340 yen, with a bear case of 840 yen and a bull case of 6,000 yen. These are the author's estimates, not forecasts or recommendations, and they emphasize the sensitivity to earnings and valuation assumptions. The bull case requires the strategic levers to work. The downside case reflects a weaker cycle and a return toward more normal valuation levels. The range is a reminder to focus on the operating indicators. Nichicon is a genuinely unusual Japanese business, a long-established capacitor specialist with finished energy systems layered on top. Its balance sheet, technical depth, and electrification exposure give it real strategic strengths. Yet its operating performance remains cyclical. NECST margins are still thin, prior targets were missed, and the current valuation is historically elevated. The balanced takeaway is to track whether the promised growth engines show up in operating profit and returns. For the full evidence, risks, and valuation discussion, continue with the free Uncover Japan Deep Dives. For a much deeper look, visit the free Deep Dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.